Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Inventrust Properties Corp. Annual Report. Inventrust Properties Corp. is a leading company that specializes in owning, leasing, redeveloping, acquiring, and managing various types of retail properties. The company's primary focus is on grocery-anchored neighborhood and community centers, as well as high-quality power centers with a grocery component. The company's business strategy involves acquiring retail properties in Sun Belt markets, disposing of underperforming assets opportunistically, and maintaining a flexible capital structure to ensure financial stability. By doing so, Inventrust Properties Corp. has established itself as a trusted and local operator that brings real estate expertise to its tenant relationships. In terms of the types of businesses and services provided by the company, they include owning retail properties, leasing retail spaces to tenants, redeveloping existing retail properties to enhance their value, acquiring new retail properties in Sun Belt markets, disposing of underperforming assets opportunistically. Overall, Inventrust Properties Corp. is a multifaceted company that offers a range of services and solutions for retailers and investors seeking high-quality retail spaces in the Sun Belt region. Unfortunately, I do not have access to the text you provided. However, I can still provide a general overview essay on what could cause a stock price to increase. The stock price of a company like Inventrust Properties Corp. can fluctuate due to various market and economic factors. One possible reason for an increase in stock price is a strong financial performance by the company, such as increased revenue or profits. This can lead to investor confidence and higher demand for the company's shares, causing the stock price to rise. Another factor that could contribute to an increase in stock price is positive industry trends. If the real estate market, which Inventrust Properties Corp. operates in, is experiencing a surge in demand or growth, it may attract more investors and drive up the company's stock price. Additionally, changes in government policies or regulations can also impact a company's stock price. For instance, if new laws or tax reforms are introduced that benefit the real estate industry, it could lead to an increase in Inventrust Properties Corp.'s stock price. Lastly, investor sentiment and market trends can also play a significant role in determining a company's stock price. If investors become more optimistic about the future of the economy or the real estate market, they may be more likely to invest in companies like Inventrust Properties Corp., causing its stock price to rise. Inventrust Properties Corp. maintains a market capitalization of $2 billion, broadly in line with the industry peer group. Inventrust Properties Corp. trades at a lower price-to-earnings ratio of 22 times and a lower price-to-book ratio of 1.33 times relative within the industry. This makes the stock valued slightly lower than its peers in the industry. This likely suggests that investors are less interested about the company, or it could be that the stock have not caught up to the industry valuation and should further be investigated. The company maintains a moderate leverage profile, with liabilities making up 33% of total assets, suggesting a balanced approach between risk management and capital efficiency. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has expanded consistently over the past 5 years, with growth supported by rising operating income. This suggests the company is profitable and financially sustainable. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The company have a dividend yield of 3.08%. The income statement shows that the company have been growing its revenue annually, and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth or decline in a business can be attributed to several key factors. Firstly, an increase in lease income, net, is a significant driver of revenue growth. This can be achieved through various means, such as fixed annual rent escalations, which result in higher average base rents per square foot, ABR/PSF. Additionally, economic occupancy rates play a crucial role in driving revenue growth. Lease renewals and extensions also have a direct impact on revenue growth or decline. On the other hand, gains or losses from the sale of investment properties can either positively or negatively affect revenue growth. Furthermore, impairment charges on depreciable real property can lead to a decline in revenue growth. These factors are interlinked, and can have a significant impact on a business's overall revenue performance. The net income of the company underwent a significant transformation between 2023 and 2025. Initially, it decreased due to defaults by retail tenants, decreased demand for retail space, and shift in consumer behavior towards e-commerce. However, this trend reversed in 2024 when the net income increased from $13,658 to $111,421, marking a staggering 693% increase. This upward trajectory continued into 2025 with an even higher increase of plus 718%. The reasons behind this dramatic change are not explicitly stated, but can be inferred as a result of improved business operations and strategic decisions. In terms of profit margins, the company experienced contrasting trends. On one hand, net FFO profit margins increased from 1.73% to 1.83%, indicating a modest improvement of plus 10%. Conversely, EBITDA margin saw a substantial increase from 8.2% to 40.3%, representing a significant change of plus 32.1%. However, the impact of reclassification from interest expense, net, and distributions declared on profit margins is unclear, as it is not directly stated in the provided information. Nonetheless, these changes suggest that the company's financial performance has undergone substantial transformations over this period. The company's financial performance indicates a steady increase in its ability to generate cash from its core operations. The data shows that the company has been able to produce positive operating cash flow for both years, with a notable improvement of $18,540 between 2024 and 2025. This upward trend suggests that the company is becoming more efficient in managing its resources and generating revenue from its core activities. As a result, it can be concluded that the company is indeed generating positive operating cash flow. The company's debt level and interest expenses have undergone significant changes. The total debt has increased substantially from $60.5 million to $500 billion over the years, indicating a substantial rise in financial obligations. This increase is evident in both the absolute numbers and the year-over-year growth rate. In contrast, the interest expenses have decreased significantly. In 2024, the company incurred an interest expense of $37.1 million, which dropped to $34.5 million in 2025, representing a decrease of $2.6 million. This reduction in interest expenses suggests that the company may be benefiting from lower borrowing costs or more efficient debt management strategies. The total mortgages payable also decreased significantly, from $117.6 million to zero, indicating that the company has either paid off its mortgage obligations or restructured its debt. Overall, these changes suggest a shift in the company's financial landscape, with increased debt levels and reduced interest expenses. Management is optimistic about the company's outlook, citing favorable demographics in Sun Belt markets that create demand for grocery-anchored retail centers. They plan to focus on acquiring high-quality assets in these markets, where they have a competitive advantage due to their strategically curated portfolio and local market presence. However, management also acknowledges various risks associated with investments in retail real estate, including expansion, development, and redevelopment of properties. They are concerned about the vulnerability of their business to natural disasters and climate change, as well as the potential negative impact of rising interest rates on borrowing costs and debt refinancing. In terms of strategy, management intends to tailor and grow its retail platform through acquisitions and dispositions, while also monitoring its liquidity position and seeking to raise funds through debt or equity financing if necessary. They plan to distribute cash to shareholders at the discretion of the board, depending on financial condition and other factors. The company's profitability and cash flow could be significantly reduced due to environmental liabilities and compliance with ESG-related laws and regulations. Additionally, management is concerned about the increasing risk of cyberattacks and data breaches, which could damage their brand and reputation, result in financial penalties and legal liability, and have a material adverse impact on their business. Despite these risks, management believes that their current sources of liquidity are sufficient to meet their short and long-term cash demands. They expect to continue evaluating the distribution rate on a periodic basis as they execute on their retail strategy. The company's strategy involves both acquiring and divesting retail properties to achieve its goals. In terms of acquisitions, the company plans to grow its retail platform through future purchases, targeting additional properties in desirable locations, particularly in Sun Belt markets. These transactions will involve acquiring various assets such as land, buildings, leases, tenant improvements, and assumed debt. The company also aims to acquire intangible value from existing leases, which can provide a competitive advantage. However, it acknowledges that competition for properties may be high, and purchase prices could be steep. On the other hand, the company will selectively dispose of retail properties that are not beneficial or no longer align with its growth strategy. This approach allows the company to focus on expanding its presence in markets with favorable characteristics, while optimizing its portfolio by shedding underperforming assets. By opportunistically disposing of certain properties, the company can redirect resources towards more promising opportunities, driving long-term growth and profitability. The company's financial history reveals a consistent practice of paying dividends to its shareholders. This commitment to dividend payments demonstrates the company's confidence in its financial stability and ability to distribute profits to its investors. On page 11, it is explicitly stated that the company has paid dividends, further emphasizing this aspect of their financial strategy. In contrast, there is no mention or indication of share buybacks being a part of the company's financial activities. This suggests that the company has chosen to prioritize dividend payments over other forms of shareholder return, such as buying back shares. That concludes the financial summary for Inventrust Properties Corp. Feel free to comment below, and I will be happy to answer them when possible.